Opendoor had a tough Wednesday session. After opening strong and rallying as high as $4.97 in the morning, the stock couldn't hold those gains. By the close, it was down 68 cents on the day, finishing at $4.02 per share, a loss of about 14.5%. For anyone just glancing at the chart, it might look like a harsh reversal. But for those of us who've been following the Opendoor story closely, it's not surprising, and it doesn't change the bigger picture. This is a volatile stock. It swings up big, and it swings down big. And often, those pullbacks are part of the process of building momentum for the next move. Now, I'll be upfront. I personally took the opportunity to add to my position in the later part of the session. That's not because I enjoy watching red candles. It's because I believe in the long-term story, and I see these swings for what they are, typical cycles of a stock that is still finding its footing but has enormous potential ahead of it. Let's unpack what happened today, why it happened, and why I remain bullish. The stock started the session strong, climbing toward the $5 level. That's been a key ceiling for Opendoor for the past week. We've seen it test and flirt with that mark, sometimes even break through intraday, but not yet establish a decisive hold above it. Today was no different. We saw buyers come in, push it as high as $4.97, and then the pressure of profit-taking began to weigh it down. By the afternoon, the selling had intensified, and the stock steadily slid lower, ending at $4.02. There are a few things worth noting here. First, this sell-off wasn't triggered by any major piece of negative news. There wasn't an earnings miss, a scandal, or a regulatory issue. This was primarily about sentiment and short-term trading. After the big run we saw last week, where the stock soared over 40% in a single day, and the continued tests of that $5 level earlier this week, it's natural for traders to take some profits. Volatility attracts traders, and traders mean quick ins and outs. That's part of the rhythm of this stock right now. Second, even with today's drop, Opendoor is still sitting at a much higher level than it was just a couple of weeks ago. Remember when we were talking about $3.50 as a floor and $4 as a ceiling? Today we're talking about $4 as the floor and $5 as the ceiling. That's progress. It's not linear, and it's not comfortable, but it's real progress. Each pullback that finds a higher base strengthens the case for the next rally. Of course, I've also noticed, like many of you have, that there's been a sense of frustration growing among retail investors online. The complaint is simple: there hasn't been a steady stream of new developments, and the board of directors doesn't appear to be taking visible action. People want catalysts. They want announcements. They want confirmation that the leadership is moving quickly to capitalize on the momentum. And when they don't see it, frustration builds. That's natural, too. Eric Jackson has tried to redirect some of that energy by pointing out that if board members or major insiders were to invest their own money into Opendoor stock, it would be a strong signal of conviction. Insider buying has always been a bullish indicator for any company. It shows alignment between leadership and shareholders. But so far, we haven't seen that kind of move here, and that leaves people wondering. Then, of course, you hear names like Keith Rabois or Travis Kalanick being thrown around. Wouldn't it be something if either of them took a leadership role at Opendoor? It certainly would grab headlines. But right now, those are speculative rumors more than solid developments. The truth is, the company is still in the process of finding its next permanent CEO, and until that decision is made, speculation will fill the void. So let's ground this conversation. What really matters for the stock going forward? It's not whether the board is tweeting every day or whether big names are floated in social media chatter. What matters are three big levers: leadership, business model, and macro environment. Leadership comes first. The CEO pick is critical. This person will set the tone for the next chapter of Opendoor. Carrie Wheeler stepping down opened up a huge opportunity for a reset. Srisha Radhakrishna has stepped in as interim, and has done a commendable job so far, especially in terms of engaging directly with retail investors and showing a willingness to embrace AI as a core part of the company's strategy. But the board needs to land on a permanent CEO who can truly scale this business. They need someone with experience in building marketplaces, someone who can balance innovation with discipline, someone who can lead the company toward being asset-light and more profitable. That's not just an operational necessity, it's a narrative driver. The right CEO can attract institutional confidence, can shape investor sentiment, and can provide the stability the market wants to see. The second lever is the business model. The original iBuyer model was groundbreaking, but it came with heavy capital requirements. Buying homes, holding inventory, carrying risk, those are big balance sheet commitments. The future for Opendoor has to be more asset-light. That means monetizing the seller funnel in more ways: agent services, financing solutions, partnerships, and platform fees. It also means leveraging AI and technology to strip out costs and improve margins. This is where Opendoor can really differentiate itself. Instead of being seen as just another real estate company, it can be positioned as a real estate technology platform, the Uber or Airbnb of housing. That's a much more scalable and much more exciting story for investors. The third lever is the macro environment. And here's where patience comes in. The housing market has been stuck in a difficult cycle because of high interest rates. But Jerome Powell's comments at Jackson Hole suggest that rate cuts are likely coming in September. If and when mortgage rates start to come down, housing activity will pick up. Sellers will be more willing to list their homes, buyers will be more willing to take on mortgages, and transaction volumes will rise. That's a direct catalyst for Opendoor. This company thrives on housing activity. When the market is moving, Opendoor has more opportunities to make money. And the timing could align perfectly: a new CEO in place, a business model pivot underway, and macro tailwinds supporting more transactions. That's the recipe for the next leg higher. So yes, today was a rough day. A 14.5% drop is nothing to shrug off. But it wasn't driven by bad news, and it doesn't change the long-term story. For me, it was an opportunity to add to my position, because I believe the ingredients for future upside are still there. I believe the frustrations we're seeing online are growing pains of a retail community that is more engaged than ever, but engagement is not a bad thing. It shows energy. It shows conviction. And it keeps pressure on leadership to deliver. Looking ahead to the rest of the week, the $4 level is now the floor to watch. Holding above it will be important. The $5 ceiling remains the battleground. If the stock can consolidate here for a while, it will build the foundation for another attempt to break higher. And when that break comes, I expect it to be strong, because the short interest is still elevated and retail conviction is still high. So my message is simple: stay patient. Volatility is part of this journey. Pullbacks are not the end, they're part of the process. The path to Eric Jackson's $82 target is long, and it will require execution from management, a pivot to an asset-light model, and improvement in the housing market. But those things are all possible, and the direction of travel is still forward. Wednesday reminded us that stocks don't go straight up. They zig, they zag, they frustrate, and they test conviction. But the story here is bigger than one red day. The story is about transformation, resilience, and opportunity. And that's why I'm still bullish.